For most people, a 401k is the single most important financial account they will ever own. Yet very few actually understand how it works. The standard experience goes like this. You sit through HR onboarding, check a default enrollment box so you can move on to the next form, and then completely forget about the account for the next 40 years. That passive approach comes with a massive hidden cost. When you accept the default settings, you are usually locking yourself into suboptimal contribution rates and high-fee investment funds that quietly eat away at your wealth over decades. And because most people ignore the specific tax code rules attached to these accounts, they make unforced errors when they eventually change jobs, often unnecessarily handing large chunks of their savings straight to the IRS. The trade-off here is straightforward. Spending 15 minutes of administrative friction today to properly set up your account secures a guaranteed return of 50% or more and helps you avoid five-figure tax traps later on. At its core, a 401k is just a retirement savings account offered by your employer. It gets its name directly from Section 401k of the U.S. tax code. The mechanism is simple. You choose to route a percentage of your paycheck directly into investments inside the account before taxes are even taken out. The IRS puts strict caps on how much you can put in. For 2024, the standard contribution limit is $23,000. If you are 50 or older, you get an extra $7,500 catch-up allowance, bringing your total limit to $30,500. But before you invest a single dollar, you hit a fork in the road. You have to choose between a traditional 401k and a Roth 401k. This comparison matrix breaks down the difference. On the left, the traditional 401k lowers your taxable income today because your contributions are pre-tax. The catch is that all your withdrawals in retirement will be taxed as ordinary income. Over on the right, the Roth 401k works in reverse. You contribute after-tax money, meaning you get no tax break today. However, all the growth inside the account and all your withdrawals in retirement are completely tax-free. The Roth option usually wins if you are early in your career. You are likely in a lower tax bracket now than you will be in the future, so paying taxes today makes mathematical sense. The traditional option often wins for individuals in their peak earning years. When your current income is high, that immediate pre-tax deduction is highly valuable. Ultimately, choosing the right structure comes down to predicting your future income bracket. The goal is simply to pay taxes when your rate is at its lowest, to minimize your lifetime tax burden. If your employer offers a matching contribution, that is the single most critical wealth-building feature of the entire account. Let's look at this flow chart mapping out a common scenario. You earn a $60,000 salary. You contribute 6%, which is $3,600. Your employer matches 50% of that amount, sliding in an additional $1,800 block directly into your account. That $1,800 represents a 50% guaranteed return on your initial $3,600 investment. No stock market asset reliably returns 50% year after year. Capturing every single dollar of this match is your mandatory first step before making any other financial investments. But there is a catch. Companies use the match as a retention tool through something called a vesting schedule. Any money you contribute from your own paycheck is 100% yours immediately. The employer's matching contributions, however, are earned over a specific timeline. This line graph illustrates cliff vesting. You own 0% of the employer match for the first 2 years. Then, exactly on a specific date in year 3, your ownership spikes vertically to 100% all at once. Other plans use graded vesting, where you earn a set percentage each year over a few years, or immediate vesting, which is the rare but ideal scenario where the match is yours on day 1. You must audit your specific vesting schedule before you put in your notice at a job. Leaving even 1 month before your cliff date can vaporize thousands of dollars in expected wealth. Once the money is actually in the account, you have to decide how to invest it from the specific menu of options your employer provides. Target date funds are the simplest option. You pick the fund closest to your expected retirement year, like 2055, and it automatically shifts your risk from stocks to bonds as you get older. Index funds are the other main option. These are low-cost funds that track broad market performance, like the S&P 500, rather than relying on an active manager picking individual stocks. Whatever you choose, check the fund's expense ratio, the annual fee they charge you. You should strictly seek out options with fees below 0.10%. Here's the math on fee erosion. On a $100,000 balance, a 0.05% fee costs you $50 a year. A 1% fee costs you $1,000 a year. Over a full 30-year horizon, that difference strips away tens of thousands of dollars from your final balance. When you do leave your job, you face another decision point. You have two safe options. Leave the money in your old employer's plan if the fees are low, or roll it directly over to your new employer's plan. Often, the most advantageous move is rolling it over to a personal IRA. This maintains your tax-deferred status while giving you total control to pick the lowest cost index funds on the open market. But there is a worst possible option, cashing out the 401k before you reach age 59 and a half. Take a look at this bar chart showing a $30,000 account balance. If you cash it out, it gets aggressively sliced down. You trigger immediate ordinary income tax on the full amount, plus the IRS takes an additional 10%. Fund an emergency savings account. Pay off all high-interest debt. Max out a personal Roth IRA. And finally, return to your 401k to max it out to the $23,000 limit. The 401k match occupies that absolute #1 slot because the mathematically unbeatable guaranteed return outpaces any high-interest debt or outside investment. If you are currently employed and not enrolled, your immediate priority is to open your company benefits portal today. Set your initial contribution exactly to the percentage required to capture every dollar of the match. Then, automate your settings to increase your contribution by 1% annually. By taking 15 minutes of immediate action, you replace the confusion of a default account with a predictable, automated system for building wealth.